In this lesson, we're going to move into the second part of creating a projection model for Apple for purposes of our LBO model here, and that is to look at their cash flow statement to make projections here and to figure out what that is going to look like going forward. Now, the reason the cash flow statement is so important in the context of an LBO model is because the company's cash flow right here, its free cash flow, determines in large part how much debt it's able to pay off each year. So if they have 10 billion worth of free cash flow, they can repay a lot more debt versus if they only had 2 billion or 3 billion or 5 billion worth of free cash flow. And the income statement is fine in terms of telling us on paper how profitable the company has been. But remember, going back to basic accounting, the reason the cash flow is so important is because often a company's true cash expenses and cash income are very different from what they're actually recording on their income statement. Now we're skipping over the balance sheet here because it's not 100% necessary to create an LBO model like this. So for the cash flow statement here, what we're going to do is going back to Apple's three-statement model here, I'm going to go down to the cash flow statement. We're going to be taking a look at this, but we're going to be making a simplified version. We're going to list net income, depreciation, amortization, stock-based comp, but we're not going to list deferred income tax expenses, losses on PP&E, because these are really one-time expenses and they don't even exist in future years. Changes in operating assets and liabilities, we're going to simplify into one line item. Under investing activities, CapEx is the only one here that changes it all in future years, so that's the only one we're going to list. And then financing activities, there's really nothing here. We're going to ignore our assumption, our previous assumption, that we actually raised debt in 2010 here. We're just going to ignore this and pretend that nothing happens in this case. The other note with the cash flow statement is that we never try to make historical cash flow statements for an LBO model. We are only concerned with projected cash flow statements. This applies, by the way, even if you have an extremely complex model. So even if you have something that goes far beyond what we're doing here, you still only concern yourself with projected cash flow statements. You never try to look at the historical statements and try to make a pro forma version for the historical years or anything like that. So to get started with projecting this here, let's begin by linking in the net income from our income statement, then the depreciation and amortization, amortization of intangibles, and stock-based comp. And this is just going back to basic accounting and basic three-statement modeling. We start with net income, then we add back non-cash expenses right here. And then we take into account the change in working capital or the change in operating assets and liabilities. So for this one, remember that our assumption here is that we're basing this on a percent of revenue now. So we take our revenue right here and then multiply by the change in working capital as a percent of revenue. And then we can sum up everything with alt equals. For capital expenditures, remember that we always use a negative sign here because capital expenditures drain our cash flow. So what we're going to do is take revenue once again, and then multiply by CapEx as a percent of revenue right here. So that gets us to free cash flow, which is defined as cash flow from operations minus capital expenditures. In this case, capital expenditures already has a negative sign, so we can just add this. And we get almost 13 billion worth of free cash flow. So this number is extremely important because it's telling us how much about Apple will actually have to repay some of its debt that's taking on in this LBO. So I'm actually going to select these and just copy them across with Alt ESF. So now we have all these formulas in place. If you go back and compare this to Apple's three-statement model, you'll see that it's pretty much the same because most of these numbers are still the same. Net income will be off by a bit because we are not yet factoring in interest income and interest expense in our model here for the LBO. Now I mentioned before that free cash flow tells us approximately what a company has to repay some of its debt obligations. But to get a more exact measure of this, a better number, a more exact number of how much they can actually repay, we need to take into account their minimum cash balance, and then we need to take into account how much is actually available versus how much they're actually using for debt repayment. So for the beginning cash balance here, I'm going to go all the way up to the very top where we had our operating assumptions, and I'm going to link to this initial cash balance of 6.5 or 6.6 billion. And so the basic approach here is to figure out how much cash we can use to repay debt. We take how much cash we started with, we add how much cash we generate, and then we subtract the minimum amount of cash that we need to keep on our balance sheet at all times. So if we go in and add our free cash flow here, we'll just link to that. Then we want to subtract our minimum cash balance. So I'm going to use a negative sign and then go once again all the way to the top and press F4 to anchor this minimum cash balance cell. So now this tells us the cash available for debt repayment. So we're going to take our beginning cash balance, that's how much we're starting with. We're going to add how much we're generating, and then we're going to subtract our minimum cash balance right here. So this is how much is actually available for debt repayment. We see that it's a bit higher than the free cash flow number here, and that is because we started with some amount of cash. We do have this minimum balance that has to be maintained, but the fact that we started with over 6 billion worth of cash means that we have 14 billion available for debt repayment versus the 12 or 13 available that we would infer from the free cash flow number. For the cash used for debt repayment, we're going to leave this one blank for now because this will depend on our debt schedules, which is the next lesson. So we're going to leave this one blank for now and come back to it. Now for the beginning cash balance here, this one's simple. We're just going to link to this beginning cash balance number at the top right here. Now for the net change in cash, so if you think about what's going on here, basically we are generating cash from free cash flow and then we are using some of this cash to pay for debt. So the net change in cash is simply going to be how much cash we're using to pay for debt plus how much cash we've generated over the course of the year. Right now this just comes out to the free cash flow number because we have not yet figured out how much in debt we're paying off each year. Now for the ending cash balance number, we can just sum these two up. We see that our cash here is going up by quite a bit, and again, that's because we have not yet calculated how much in debt we're paying off each year. So to carry this formula across, you have to be a bit careful because for the beginning cash balance, you don't always want to be linking to the initial number up there. Instead, what we want to do is for the year 2 beginning cash balance, we're going to link to our ending cash balance from year 1. And the same goes for year 3. We link to our ending cash balance from year 2. For year 4, we link to our year 3 ending cash balance, and so on. For the rest of the formulas though, we can pretty much just copy these across as is. So select everything, copy it across with Alt-ESF. And there we have our calculation for each year. We see approximately how much cash is available for debt repayment. It's going up by quite a bit. And our overall cash balance here is also going up by quite a bit each year. Again, primarily because we've not yet calculated how much we're actually going to be using to repay debt here. So this is the basic sketch, the basic outline for the cash flow statement that we're going to be using in our LBO model. It is not yet complete because we have to go into detail on the interest expense and the debt repayment now, which is really the core of an LBO model like this. But this tells us at a glance how much cash is available to repay debt, how much cash the company is actually using for that purpose, and then overall, how does Apple's cash balance here change from year to year. So with all this in place, in the next lesson, we're going to get into this remaining item, this final remaining item, on how much cash they're actually using to repay debt. And we're going to create something called a debt schedule that tells us how much debt is being repaid each year, what kind of interest expense are they paying on debt each year, and shows us in more detail how these numbers are changing over time.